Welcome back to Investors Reality. The proxy war between the West and the East is continuing. The West have already implemented 8 rounds of sanctions against Russia, and they are hurting the Russian economy. But nothing could hurt the Russian economy as the new sanction proposed regarding the oil price caps. In today's video, we will be looking at the financial implications of Russia's invasion of Ukraine on the global economy. And today I want to talk about oil prices and the proposed oil price cap that will be applied against all Russian exports of oil. As I'm sure you already know, oil represents the single largest revenue for Russia. In 2021, Russia earned over 100 billion from oil exports, which equated to around 20% of its total revenues. And this was at a price that is significantly below where market levels are right now. So as we all know, oil is really important to Russia, and the future of those revenues depends on whether or not Russia will be able to replace all of the exports that it's losing to the West as a result of the financial sanctions that are in place, and replace them predominantly with sales to India and China. However, with that comes the question of secondary sanctions. So in today's video, I want to walk you through exactly what's been happening with oil prices, because they have been fluctuating. At the start of the war, we saw a huge increase in prices, but since that time, we've seen quite a lot of movement. So we have to look exactly at where we are right now, and I will also show you some really interesting month-by-month demand and supply chart that's produced by McKinsey, which shows how sensitive oil prices are to those movements and what's happening in the markets. But before we start, I do want to welcome you to Investors Reality. This is where I try to analyze some of the current geopolitical events and what impact it could have for the global financial markets. This chart shows the movement in crude oil prices over the last 12 months. So you can see that this time last year, a barrel of crude oil was priced at around $81. Prices started to fall towards the end of 2021, but as we moved into January, there was a steady increase in price. And of course, Russia's invasion of Ukraine on the 24th of February has also caused further implications. So prices had got up to around $90 per barrel. As soon as the invasion started, prices jumped to around $120 per barrel. And over the course of the first 3 months of the war, prices were highly volatile and ranged between $90 to $120. However, since early June, we've seen a marked reduction in oil prices, and they're now trading somewhere in the region of $90 per barrel, which was roughly the same price that we had prior to the invasion starting. Now, of course, the price of $90 per barrel has to be put into perspective. And if we look at this chart, which shows the 5-year average oil price, you can see that on average, prices have been trading at around $65 per barrel over the previous 4 years. So the last 12 months on average represents a period of high oil prices. In terms of what determines the price of oil, this is almost the perfect market in terms of demand and supply. If demand exceeds supply, well, then the price goes up. If supply exceeds demand, then the price goes down. Now, generally speaking, the demand for oil is linked to the global economy. If the global economy is growing, then that usually means that there's a growing demand for oil. If the global economy, however, is retracing or reducing, well, then that means there will be a big reduction in demand for oil. In terms of supply, the situation is slightly more complicated because there is a limited number of countries that produce and export oil. They generally operate on a cartel basis, now referred to as OPEC. And OPEC is a collection of 23 countries who all have a collective agreement not to produce more than a certain amount of oil. And the reason that they do that is that they want to maintain price stability. They don't want the market to become flooded for supply, to exceed demand, and therefore the price of their valuable resources to drop. And what they do, and they much rather reduce their output in order to maintain high prices to ensure that they make good profits on all of the oil that they are producing. Obviously, they don't want the market to become flooded for supply, to exceed demand, and therefore for the price of their valuable resources to drop. They would rather reduce their output to maintain high prices to ensure that they make good profits on all of the oil that's produced. And that's because there's a high fixed price in producing a barrel of oil. You have to spend a lot of money on all the infrastructure, get everything in place, and your whole business model is based upon achieving a certain price when you sell that oil. What you don't want to be doing is producing large volumes of oil and selling them below cost. So that's why OPEC came up with these production limits, because they want to make sure that they're all making good profits. And if the price does come down for some reason or another, then they will simply reduce the amounts of production to get that price back to an acceptable level. So the supply of oil is not like any of the markets in the majority of other sectors. You have companies that are trying to produce as much as they can to maximize their sales value. They all want to sell as many products at the best price possible. To get the maximum amount of profit in oil, it's really a fine balancing act in terms of supplying not too much and not too little. And as we can see here in the chart, which I will show you, you can see the movement in demand and supply for oil and how that affects price. This chart shows the movements in oil prices, demand and supply, and stock levels for the period dating back to January 2020. The blue line at the top of the chart is the price of a barrel of oil in US dollars. You can see that back in January 2020, a barrel of oil was trading at $64. We then saw a decline in the price for the next 4 months directly related to the COVID-19 pandemic. Now, a lot of countries around the world started introducing lockdowns. So a lot of businesses started shutting down. People were staying at home. They weren't going to work. They weren't using their cars. And therefore, we saw a big drop in demand. And by April 2020, the price of a barrel of oil had fallen to $18, which was a level that we hadn't seen around the world for a long period of time. Now, from that low point, prices did recover. You can see there's been a steady increase in the price of a barrel of oil since that time. But now let's have a look at what is happening right now to demand and supply. So if we look at the next two lines on this chart, the light blue line shows the global supply of oil and the darker blue line shows the global demand for oil. So you can see that at the start of 2020, around the first 4 months, around 100 million barrels of oil were being produced globally per day. In January, the demand for oil was 96 million barrels. In February, it was 97 million. So both were slightly below the amounts of oil that was being produced. However, in March, we saw a significant decline in demand down to 91 million barrels. And then in April, demand fell to 81 million barrels. So in that month, there was a differential of 18 million barrels of oil per day. So the production was significantly above the amounts of demand, and that's what drove the massive reduction in price from $64 per barrel to $18. Now, as we spoke about earlier, the oil-producing nations of the world, they don't want to keep producing large amounts of oil in a falling market. So as a direct result of the fall in demand, the amount of oil being produced was cut significantly. And you can see in May, the amount of production was reduced to 88 million barrels per day, which was still above the 85 million barrels demand per day at that point. However, production was held at 88 million in June, and you can see that demand actually increased to 90 million. So for the next 6 months, production was deliberately held below the level of demand to make sure the prices started to increase. As I mentioned before, if demand is higher than supply, then that leads to an increase in price. But of course, this is all relative, because if you look at the prices above here, you can see that they were rising to around $40 to $45 compared to $64 that we had back in January 2020. And now let's skip forward and look at what's been happening over the past 18 months. And there you can see that the level of production globally has been deliberately kept low to keep working that price up. So up until the start of the war in Ukraine, we saw a steady increase in oil prices. And by January 2022, the price was at $87 per barrel. And if we look at the bottom section of this graph, you can see that the bars indicate the amounts of inventory that each of the countries was sitting on. So this is oil that's been extracted from the ground that's either in a crude or refined state that hasn't actually been sold to any end users yet. And you can see that in that period, that production was reduced. There was a huge increase in the amount of inventory that all of these countries were sitting on. So basically, they were still pumping oil out of the ground, but they weren't releasing it into the markets. And over the course of the last 18 months, you can see that those inventories have been managed down. And by January 2022, global inventories of oil were sitting at 4.2 billion barrels, which is the lowest point in any period back to January 2020. Now, what is really interesting is to look at what's happened to prices and demand and supply and inventory in the period since Russia's invasion of Ukraine. So what we can see is that in the first 5 months from February through June, prices increased dramatically and are shown at the highest level of $123 per barrel in June 2022. Now, under normal circumstances, an increase in price would either be driven by an increase in demand or a reduction in supply. However, if you look at what's happened over that period, you can see that the supply of oil has actually remained flat at 99 million barrels of oil per day, and demand actually dropped during that period. So what we are seeing here is that the rise in the price of oil is being caused largely as a result of speculation and the concerns about future supplies of oil rather than what's happening on a monthly basis. Because when you look at the demand and the supply chart, there's absolutely no reason why prices should be increasing. And if we now look at July, August, and September, you can see that the amount of global production has actually increased to around 102 million barrels per day. And as a result of demand remaining, flat prices have now started to come back down. So the market is now operating in more of a normal fashion because supply is exceeding demand, which is pushing down prices. And if you look at the bottom of this chart, you can see that the producers are now starting to build up their inventory levels again. So they're still producing oil, but they're holding it back because they don't want to have a massive fall in global oil prices. But this chart is also really interesting because it shows the 5-year range of demand for oil. And as you would expect, 2020 is the year that marks the lowest levels of demand. But I think what is interesting about this chart is if you look at the global levels, is that demand in 2022 is actually close to the 5-year high. So we're not far away from being at record levels of demand. And if you look at the other two charts, it's interesting to see the split between OECD and non-Arab OECD countries. So the OECD countries are predominantly the countries of Europe plus the United States of America, Australia, New Zealand, and Canada. So essentially equates to the demand from the West versus the non-OECD countries, and that includes China and India and lots of Asia. And you can see that in 2022, demand from the non-OECD countries, so the non-Western countries, is actually at the record level at any time in the last 5 years. So essentially what we got here is a lot of emerging and developing countries who are seeing that year-on-year growth and a higher and higher demand for oil. And if we look at the global statistics for supply, you can see that from May onwards, 2020 was at the bottom of the 5-year range, and 2021 is very close to being at the highest levels for the last 5 years. And if you look at the breakdown of that, the core 10 countries that represent OPEC have been producing close to 30 million barrels per day. But the non-OPEC countries, which include the United States, have been producing closer to 60 million barrels per day, which is actually the highest rates that we have seen for the last 5 years. And just before we move on, I thought it was worth looking at the production levels from Russia for 2022. And as you can see that in April this year, there was a reduction from 11.3 million barrels per day to 10.3. However, since that time, it's been reported that there's been a gradual increase, and in September, production was up to 10.9 million barrels per day. And finally, let's look at what's going on with regards to the proposed oil price cap for Russian oil exports. The G7, they've been working on a mechanism whereby they will limit the amounts of money that Russia can earn from each barrel of oil it sells. And the way that they will affect that is through insurance and other logistics relating to the shipping of oil. Now, this will work in two ways. Firstly, if any of the countries in the G7, which are the 7 largest economies in the world, or the European Union or Australia, they have also confirmed that they will support this oil price cap. So if Russia wants to sell to any of those countries, and that includes most of the largest economies in the world, it will have to do so under the terms of this price cap. If it wants to sell at a higher price, then obviously it would lose all of those markets overnight. Now, Russia stipulated that they are vehemently opposed to this price cap and they won't sign up for it. Well, was to expect, right? So the only way that it will work is if the G7 and Europe can persuade all the other countries in the world to sign into it as well. And the way that they will do that is that it will be linked directly to the transport of that oil, because Russia needs to put this oil onto ships, and those ships need insurance and a variety of other logistics. So Russia is currently trying to organize its own transport, but it simply doesn't have enough ships. And the S&P, they have recently undertaken a full analysis of the market, and they estimate that Russia, they are at least 110 ships short of being able to bypass this price cap. So that means they would need to charter ships that are either owned by the West or insured by the West. And the only way that they would be able to use those ships is if the cargo going onto them is party to the price cap agreements, obviously. So this isn't really something that Russia can avoid, because if they can't move the oil, well, then they can't make the sale and therefore they can't get the revenue. So it is a catch-22 from Russia's perspective. They simply don't have enough infrastructure to be able to avoid the current price cap. So the big question obviously is, what price would this oil cap be set at? And we have now seen information that shows that the price being discussed is somewhere between $63 and $64 per barrel. Now, if you think back to the charts that we have been looking at, the last time we saw prices at those levels were back at the start of the COVID pandemic. In fact, before the pandemic started, oil was trading at $64 per barrel, and that represents a major reduction against current market prices. Now, Russia is already selling at a discount. It has been reported that the deals that it's doing right now are being done at around $75 per barrel. But an enforced reduction through the price cap of around $30 per barrel represents a loss of income of around $300 million per day for Russia, because they are selling around $10 million barrels every single day. Now, the European ban on purchasing non-pipeline crude oil starts on December the 5th, and it's planned that this oil price cap will be in place before that date. So over the course of the next few weeks, we are likely to see an announcement that the oil price cap has been agreed. The price will officially be released, and then all of the countries involved will be operating that cap directly. And all of the insurance and shipping industry companies will be instructed that they need to enforce this cap all around the world. Now, from everybody else's point of view, this cap is actually beneficial. And especially if you're India or China, because you're currently paying $75 per barrel directly from Russia. So with this oil price cap, it will reduce the amount to $63. Now that's a win-win from their perspective, because they can still keep buying all of that oil directly from Russia. So they're getting their supplies that they need, but getting it at a significantly lower price. There's no real downside from India's or China's point of view. They're not actually setting the rules of this game, so they can easily say to Russia, hey, this is not our decision. But I'm sure that they do not want to run the risk of the secondary sanctions being applied against their countries with regards to all of the trade that they're doing with the West on all other fronts. So they can use this as a really good excuse that they don't want to hurt their own economies. But actually, as you know, they don't really have a choice. So it's a great idea from everybody's point of view, of course, except from Russia's point of view. Obviously, from Russia's perspective, all it sees is a massive reduction in revenue. However, they'll still be able to keep producing all of their oil, they just won't be able to maximize their profits on it. Now let's refer to Russia's threat of not producing any oil or actually pulling out of the global markets. I don't think that that's really realistic, because once you've got set up those facilities, once you've got all that oil pumping and you're releasing 10 million barrels of oil per day, the last thing that you want is to switch off those supplies, because that will cause major problems in the future. It could even mean that you would never get those facilities going at the same level ever again, or let's say in the near future. And this, of course, is coming at a time when Russia is losing all of its Western business partners and they are fighting a proxy war against the US in Ukraine. So this is a really difficult situation for Russia. And I think it's likely that this oil price cap will be put in place by the West. So the big question is, will Russia ultimately fall in line and agree to it? Or will Russia, in alliance with the BRIC countries and the Shanghai Cooperation Organization, pull another rabbit out of their hat? Only time will tell, but thank you for watching Investors Reality.